Tomorrow is the big one, the release of August's US non-farm payroll data. But more importantly, this is the data that is expected to impact how much of a cut the FOMC will make at its September meeting in a fortnight's time. So what is non-farm payroll, and does the gold price really care about it? Let's find out. Non-farm payroll, or NFP data, is released by the US Bureau of Labor Statistics on the first Friday of every month. It can significantly impact gold prices in the short term due to its influence on investor sentiment regarding the US economy. But it is of particular interest this week because investors believe it will impact the size of the Federal Reserve's first interest rate cut later this month. So, what even is the non-farm payrolls data? Well, non-farm payrolls account for 80% of US workers contributing to gross domestic product, or GDP. The data excludes farm workers and several other job classifications, as well as active duty military personnel. Now, the Bureau of Labor Statistics collects this data and it is featured in the monthly employment situation report. Now, the monthly situation report is made up of the household survey and the establishment survey. And why do they matter? Well, the household survey data reveals trends in the unemployment rate and participation rate that may be associated with demographics. And the establishment survey data offers valuable information on job changes within sectors or industries. Now, clearly, the employment situation report contains insights into the labour force, and so this directly impacts the economy, the stock market, value of the US dollar, value of treasuries, and more often than not, the price of gold. Now, part of this is the non-farm payroll data, as this contains the data and statistics regarding the employment situation in the US. And so this can be used to identify various trends, whether it's economic growth, inflation, GDP, housing stats, etc. And all of these affect the movement of financial markets. So in short, the non-farm payrolls data is considered a key indicator of the overall health and direction of the US economy. And of course, who is really concerned about the health of the US economy right now? The Federal Reserve, or more specifically, the FOMC. So let's bring this back to today, or rather tomorrow. The reason why non-farm payrolls is so crucial this time around is because when Fed Chair Jerome Powell spoke at Jackson Hole last month, he made it clear that the Fed is focused on the risks of a weaker job market. And so it's safe to say that payrolls data is front and centre when it comes to what is influencing the FOMC's decisions this month. So what do we think the FOMC will do? Well, it seems investors are still unsure whether there will either be a 0.25 percentage point or a 0.5 percentage point cut at the next meeting. Futures suggest a 0.25 point cut is most likely, but pricing implies a 30% probability it will be deeper, according to the CME's FedWatch tool. And what do we know? Well, July's non-farm payrolls really did disappoint. There is even more weight being placed on this month's results, or August results. And this is because each report comes with revisions from the previous month, as more accurate data becomes available in the weeks following. Significant revisions to previous reports can affect market sentiment and investor confidence, as well as the current results. Now, positive revisions indicating better than expected job growth or a stronger labour market than the previous report can boost investor optimism and potentially reduce the demand for gold. But negative revisions cause uncertainty and thereby boost the appeal of gold as a hedge against market volatility. Now, that's when things are, let's say, normal. But if we see a positive revision this time around, along with positive job numbers, the expectations for a chunky interest rate cut will climb and vice versa. And this really will impact the price of gold in the short term. Now, what can we expect in this month's payroll? Who knows? According to a Reuters poll, economists expect 163,000 jobs to have been added to US payrolls in August. But looking around, there is some major variation in individuals' forecasts. And what about elsewhere in the labour market? What about other measures, other data sets? Well, earlier today, US private job data was released. And according to the ADP National Employment Report, the August job growth reached its lowest point since January 2021, i.e., when we were in a global pandemic. Economists have predicted a gain of 145,000 positions, but the actual increase was significantly lower at just 99,000. Additionally, July's job figures were revised down from 122,000 to 111,000. Now, as we know, labour data heavily impacts financial markets as it influences monetary policy and economic forecasts. So these disappointing August numbers for private employment are already sparking speculation that the Federal Reserve may reconsider its cuts. With the stock market sensitive to economic indicators, increased volatility is likely as investors process these unexpected results. Now, the broader picture indicates growing strain in the labour market. There's a slowdown in job creation, which could reflect wider economic uncertainties, including the inflationary pressures and geopolitical risks. So, where are we? What does this leave us with? Well, we've got a mixed view. We've got poor private job market data, and we have potentially strong non-farms data, as in those predictions we mentioned. And despite this mixed outlook, really, the unemployment rate is still projected to dip slightly to 4.2% from July's 3-year high of 4.3%. So, this context suggests that while the labour market is not in crisis, it is showing some signs of slowing down. But tomorrow's non-farms could actually be horrible. And this is because the yield curve has now flipped. This means that the inversion between the US 2 and 10-year Treasury yields turned positive for the first time in 2 years. And why does this matter? Well, previously, this change has historically indicated that a recession is likely in the near future, hence why tomorrow's data could be horrendous. And this is likely to impact the FOMC's decision and by how much it will cut rates. And all in all, what does this mean for gold? Well, the relationship between gold and interest rates has been a funny one in the last couple of years. Gold has hit high after high, and this is despite interest rates going up on a global scale. Now, this doesn't mean that there is no relationship between them anymore. Gold will react when non-farm payroll data comes out tomorrow, and that's because it will affect the Fed's interest rate decision. The Fed's interest rate decision does matter to the wider economy, and I don't just mean in the US. However, gold has taken its path of its own of late. It has forged some serious independence away from the US dollar and away from the paper market. Instead, it has held its own and shown that physical demand is really what matters. In the short term, the FOMC decision will impact gold, but that is just one slice of the pie. The Fed will start easing, and we believe an easing in Fed policy is likely another positive for gold. Research from UBS shows that in recent easing cycles, median gains for gold were higher 12 months after the first Fed cut. And in fact, in previous Fed easing cycles, gold gained as much as around 9% over 2 to 3 quarters after that first cut. So in terms of where this takes gold, it's got strong support right now. But a recent guest of ours expects $3,000 in the near future. So why don't you click here to find out more?